depreciating, cash feels like it's losing value just sitting there. So people invest everything. They're fully invested. Maximum exposure to the market. This seems smart when things are going well. You're capturing all the gains. But here's what happens. During a recession, everything drops. Your investments are suddenly worth half what they were. You need cash for emergencies. Maybe you lost your job. Maybe unexpected expenses hit. So you're forced to sell your investments at the worst possible time at the bottom. When prices are lowest, you lock in your losses. You miss the recovery, and you have no cash left to buy anything on sale. Meanwhile, the wealthy, they've been holding cash, waiting. Yes, that cash wasn't growing during the good times, but they weren't trying to squeeze every last percent of gains. They were staying liquid, keeping their powder dry. When the recession hits and everything goes on sale, they have cash ready. They're not force sellers. They're eager buyers. Let me give you a concrete example. Let's say you have $50,000 in 2007. You invest all of it in index funds because the market's been great. 2008 hits, your $50,000 is now $25,000. You panic. You need money for expenses. You sell at $25,000 and lock in that loss. Now, compare that to someone who kept $20,000 in cash and invested $30,000. When 2008 hits, their $30,000 drops to $15,000. It hurts, but they don't need to sell because they have that $20,000 cushion. Better yet, they can use some of that cash to buy more investments at crashed prices. Fast forward to 2010. The market has recovered. The first person is still trying to rebuild from $25,000. The second person's investments have bounced back and the extra shares they bought at the bottom have doubled. Same starting amount, completely different outcome. The liquidity advantage isn't just about having money. It's about having options when everyone else is desperate. Here's the uncomfortable truth. The financial system is designed to transfer wealth from people who need cash now to people who can afford to wait. Recessions are just when this transfer happens fastest. The third reason wealthy people love recessions is why call income insurance. Most people's wealth is their job. They trade time for money, one income stream. When that stream dries up, panic sets in immediately. But wealthy people structure their finances completely differently. They have multiple income streams, rental properties, dividend, paying stocks, business ownership, royalties, investments in various companies. When a recession hits and one income stream slows down, they have others that keep flowing. Here's where things get interesting. Not only do multiple income streams provide security, but during a recession, you can build these streams for cheap. Real estate becomes affordable. Businesses are for sale at discounts. Dividend paying stocks are on clearance. So, while the wealthy might see one or two of their income streams decrease, they're simultaneously buying 5 more at recession prices. Let me tell you about Marcus. He's a software engineer making $120,000 per year. Great salary, but it's his only income source. His entire financial life depends on his company not laying him off. 2020 pandemic hits. His company does layoffs. Marcus is terrified. He has maybe 3 months of expenses saved. No other income. His investments are down 40%, so he can't sell those. He ends up taking the first job he can find. Lower pay. He's just trying to survive. Compare that to Jennifer. She's also a software engineer, also making $120,000 per year. But Jennifer spent the previous 5 years buying a small rental property and investing in dividend stocks. Her rental brings in $1,000 per month after expenses. Her dividends are another $800 monthly. It's not enough to live on, but it's something. When she gets laid off, she's not immediately desperate. She has $1,800 per month in passive income plus savings. She can be selective about her next job. She can negotiate better. She's not accepting the first offer out of fear. Even better, she sees real estate prices dropping. She uses this time to buy another rental property at a 30% discount. 2 years later, Marcus is still recovering financially. Jennifer has 2 rental properties and actually came out of the recession wealthier than she went in. The difference wasn't their salaries, it was their structure. Income insurance means you can be patient when everyone else is desperate, and patience during a crisis is worth more than almost anything else. Here's the fourth principle, and honestly this one might be the most important. I call it the knowledge gap. Most people don't understand how money actually works. They know how to earn it at a job, maybe how to save it, but they don't understand assets, liabilities, cash flow, valuations, or market cycles. This isn't their fault. Nobody teaches this stuff in school. Most parents don't know it either. So people bumble through life expressing gratitude. Just sitting there, cash seems to be losing worth. People therefore invest everything. They have put all of their money into it. Maximum market visibility. When everything is going well, this makes sense. All of the gains are being captured by you. However, this is what occurs when there is a recession. Everything falls. All of a sudden, the value of your investments has dropped to half. For emergencies, you need money. You may have lost your job. Perhaps unforeseen costs arose. As a result, you are compelled to liquidate your investments at the lowest feasible point. You lock in your losses when prices are at their lowest. You lose out on the recovery and are left with no money to purchase anything that is on sale. The wealthy, meanwhile, have been waiting with cash in hand. While it's true that during prosperous times, that money wasn't increasing, they weren't attempting to maximize profits. Their powder remained dry as they remained liquid. They have money set aside for when the recession strikes and everything goes on sale. They don't sell things under duress. They are enthusiastic purchasers. I'll give you a specific example. Assume that in 2007, you have $50,000. Because of how well the market has been doing, you put all of it into index funds. When 2008 strikes, your $50,000 becomes $25,000. You go into a panic. You require funds to cover your expenses. You lock up that loss by selling at $25,000. Now contrast that with a person who invested $30,000 and held on to $20,000 in cash. Their $30,000 falls to $15,000 when 2008 strikes. Even if it hurts, they have the $20,000 cushion, so they don't have to sell. Even better, they can utilize a portion of that money to purchase more investments at discounted rates. Let's fast forward to 2010. The market has bounced back. Rebuilding from $25,000 is still a challenge for the first person. The additional shares that the second individual purchased at the bottom have doubled in value, and their investment have recovered. Same initial sum, entirely different result. Having money is only one aspect of the liquidity advantage. It all comes down to having choices when everyone else is in dire straits. This is the unsettling reality. The purpose of the financial system is to move wealth from those who require immediate cash to those who can wait. The fastest time for this transition to occur is during recessions. What I refer to as income insurance is the third factor that makes recessions appealing to the wealthy. The majority of people's job is their wealth. They exchange one source of income for time. Panic strikes instantly when that stream stops. However, wealthy people have very distinct financial structures. They have a variety of sources of income, including dividend-paying stocks, rental properties, business ownership, royalties, and investments in different businesses. When a recession hits and one income stream slows down, they have others that keep flowing. This is where the interesting part begins. Having several sources of income not only offers security, but it's also inexpensive to establish them during a downturn. Real estate becomes affordable. Discounts are offered on businesses. Stocks that pay dividends are being cleared. So, while the wealthy might see one or two of their revenue streams decrease, they're concurrently buying 5 more at recession prices. Let me tell you about Marcus. His annual salary as a software engineer is $120,000. Although it's his only source of income, the salary is excellent. His entire financial future rests on his employer not firing him. 2020 pandemic hits. His business makes layoffs. Marcus is afraid. He may have saved enough money for 3 months. No other income. He is unable to sell his investments because they have dropped 40%. He ends up taking the first job he can find. Lower pay. All he wants is to live. Think about Jennifer. She's also a software engineer, also making $120,000 per year. However, Jennifer has been investing in dividend stocks and purchasing a modest rental property for the past 5 years. After expenses, her rental income is $1,000 per month. Each month, she receives an additional $800 in dividends. Even if it's not enough to sustain her, she doesn't become instantly desperate when she loses her job. She has $1,800 a month in passive income, plus savings. She may be picky about where she works next. She can negotiate better. She's not accepting the initial offer out of fear. Even better, she sees real estate prices dropping. She takes advantage of this opportunity to purchase another rental home at a 30% savings. After 2 years, Marcus's financial situation is steadily improving. Jennifer is actually wealthier now than she was when the recession began, and she owns 2 rental homes. It was their structure, not their pay, that differed. When everyone else is in a terrible situation, having income insurance allows you to remain patient. Furthermore, in times of crisis, patience is more valuable than practically anything else. The fourth premise is this one, and to be honest, it may be the most significant. I refer to it as the knowledge gap. Most individuals don't understand how money genuinely works. They may know how to save it or earn it at work, but they have no idea what assets, obligations, cash flow, values, or market cycles are. They are not to blame for this. This is not taught in schools. The majority of parents are also unaware of it. People thus stumble through life, making financial decisions based on their emotions and the advice of their pals. When the economy is doing well, this ignorance is not a major problem. All boats are lifted by the rising tide. Even poor investments generate profits while the market is expanding. However, the information gap becomes fatal during a recession. People are unaware of what is truly valuable and what is merely pricey. They are unable to distinguish between a short-term decline and a serious issue. They have no idea how to assess opportunities. As a result, their dread drives them to make horrible choices. The wealthy, however, have studied the workings of money for years. They comprehend the foundations of business. They are proficient at financial statement reading. They are able to determine if an item is overpriced or underpriced. Their expertise turns into a superpower during a recession. They can remark, "This company still has strong cash flow, low debt, and a great product," when they see a worn-out stock. Its 70% decline is due to fear rather than fundamentals. It's a purchase. Alternatively, they can examine real estate and determine that while purchase costs have decreased by 40%, rents haven't decreased substantially. Just now, the cash-on-cash return tripled. That presents a chance. In the meantime, those who lack this knowledge are merely making educated guesses, reading the news, and acting in whatever way that seems safe. Consider it this way. Consider yourself at a car auction at a difficult period. Because they need money, everyone is selling their cars. You can decide not to buy anything if you have no knowledge of vehicles out of fear of being taken advantage of. Or you could purchase a flashy object that turns out to be a lemon. However, if you're a mechanic with extensive knowledge of automobiles, you'll be able to identify the truly amazing offers. You can tell which cars, despite their rough appearance, are sturdy. You are aware of which issues require costly versus inexpensive solutions. When it comes to financial assets, the knowledge gap is identical. This is what gives it even greater potency. Knowledge-based substances. It gets easy to study more the more you understand about investing and finance. The patterns begin to become apparent. Rich people frequently spend decades accumulating this body of knowledge through reading, enrolling in classes, making modest investments and learning from them, and speaking with mentors. They are therefore not learning on the fly when the recession hits. They're not panicking and attempting to decide what to do. They're already aware. They've spent their whole adult lives getting ready for this chance. I refer to the fifth and last point as the patience paradox. This one is especially intriguing as it contradicts all of the lessons we've been taught about success. We live in a modern culture. Instant satisfaction, rapid success, and strategies to become wealthy quickly. Everyone is looking for yesterday's outcomes. Here's the conundrum, though. Being willing to wait is the quickest way to accumulate true wealth. Rich folks are not in need of money at the moment. They have enough for a comfortable lifestyle. Thus, they are able to base their investment choices on time horizons of 5, 10, and 20 years. In a recession, they can purchase anything at a discount and keep it. Give it time to heal. Allow it to develop. No need to sell right away. Most people are unable to achieve this. They urgently require outcomes. They have limited runway, debt to service, and expenses to pay, so they need that investment to pay off quickly. Therefore, they frequently sell too soon, even if they are able to purchase anything during a recession at a favorable price. When it lowers further or they need the money, they get afraid. The luxury of patience is not available to them. According to the patience paradox, prosperity fosters patience, which in turn fosters more wealth. The loop keeps repeating itself. Allow me to explain why this is particularly effective during recessions. Purchasing assets during a recession frequently results in worsening conditions before improving ones. Stocks might decline by 20% further. It could take a year for the real estate market to collapse. People who lack patience sell at these decreases because they are panicking. They believe that they erred. They are unable to bear the emotional toll of seeing their investment decline. However, wealthy investors are aware that downturns are temporary. There are cycles in the economy. Everything that goes down will ultimately rise again. They have the financial and emotional capacity to endure the short-term suffering. Better yet, they purchase more when prices continue to decline. Their cost base is averaged down. They amass assets at even more favorable rates. The recovery follows. This is where the magic takes place. The investments they purchased before the recession don't just return to their prior values. They frequently continue to soar to new heights. And all of that upside is captured by the affluent investors who persevered through the bad. The impatient investors who sold during the downturn are now observing from the sidelines and wishing they had waited. Here's an actual instance. It was in the midst of the 2008 panic that Warren Buffett made a $5 billion investment in Goldman Sachs. He earned more than $3 billion in profit from that investment during the ensuing years, in addition to dividends. Here's the problem, though. Within the first few months following his investment, the shares of Goldman Sachs continued to decline. People believed he was insane and that he had made a grave error. Buffett was unconcerned. Next month, he had no intention of making money. He has the long term in mind. That is the manifestation of the patience paradox. Let me now take a moment to blow your head. All 5 of the ideas I just described have nothing to do with recessions. They center on a basic distinction between the perspectives of wealthy individuals and those of the general public regarding money. The majority of people believe that money is a scarce resource that must be properly guarded since there isn't enough of it for everyone. This mindset of scarcity makes perfect sense if you were raised in a low-income household. If you have ever been in financial instability, your brain has been taught that money is valuable and that any loss is risky. However, wealthy individuals live abundant lives because they have planned their lives to have margin, options, and several routes to success, not because they're ignorant or privileged. This abundance perspective allows them to see opportunities where others see threats. This is what no one wants to acknowledge. Those who already have resources are intended to be rewarded by the system. It's unfair. It is incorrect. But that's the truth. Recessions are just when this becomes most clear. A person with money, experience, several sources of income, and patience will always buy assets from someone lacking these things. Here's the good news, though. You're able to switch between categories. You don't have to be wealthy from birth. There is no need for a trust fund. You don't have to be a lottery winner. You need to start building the 5 advantages we just discussed, even in tiny ways. Begin studying investment and finance. Create an emergency fund to ensure you have cash on hand. Establish a second source of income, no matter how tiny. Be patient when making investments. Rather than selling in a panic, purchase assets when the market next declines. These factors accumulate over time. You may only need to survive your first recession. Your second recession can be about staying stable. It may be about thriving during your third recession. Allow me to introduce you to David. Smart guy, works in marketing, makes around $70,000 per year. David is doing fairly well in 2019. He had almost $15,000 saved up. Since everyone is raving about how much money they're making, he begins investing in the stock market. He invests all $15,000 in IT stocks. They're attractive. They're expanding. His portfolio jumps to $18,000 in only a few months. David thinks he's brilliant. He's considering giving up trading and his job. Then March 2020 hits. Market crashes and pandemics. In 2 weeks, his $18,000 portfolio falls to $10,000. Every single day, he loses money. He has trouble falling asleep. Every hour, he updates his brokerage app and observes its decline. His pals are also in a panic. Everyone is talking about how this is similar to the Great Depression and how it will only get worse. David can't take it anymore. Everything he sells is for $10,000. He's merely trying to halt the bleeding, save what's left. He currently has $10,000 in cash. He feels defeated yet also safer. $5,000 of his initial funds were lost. He declares that he will never make another investment. The market bounces back throughout the following year. If David had simply held, his portfolio would have grown to over $30,000 by the beginning of 2021. However, because prices have increased since he sold, he is sitting on that same $10,000, watching from the sidelines, too afraid to get back in. David was caught in every trap. He felt compelled to sell as there was no liquidity, no patience to weather the storm, no understanding of market cycles, and no alternative sources of income to relieve the strain. He made a short-term loss last a lifetime. Allow me to introduce you to Rachel. She also works in marketing and earns roughly $70,000 annually. But Rachel has been preparing differently. For a few years, she has been reading about personal finance. She is aware of market cycles. She is aware that recessions do occur. She is aware that they generate chances. In 2019, Rachel has $30,000 saved, but she doesn't invest all of it. She puts $15,000 in a high-yield savings account as her emergency fund. The remaining $15,000 is invested in index funds. She has also been providing freelance social media consulting as part of her side gig. It barely comes in about $500 per month, but it's something March 2020 hits. Identical crash. Her investments of $15,000 fall to $9,000. Rachel is terrified. She's a person. Seeing your money vanish is unsettling. She doesn't panic, though. She has her emergency reserve of $15,000. She has a stable job. In fact, as more businesses move their operations online, her side business is gaining more customers. Thus, Rachel does something else rather than selling. She purchases further index funds at the crash prices using $2,000 that she took out of her emergency reserve. Her coworkers believe she is crazy because she keeps throwing good money after bad. As long as the market remains low, Rachel simply grins and continues to make modest monthly purchases. Early in 2021, her initial $9,000 has increased to $15,000. However, the additional $2,000 she put in at the bottom is now worth about $4,000. Additionally, during the pandemic, her freelance work expanded. Her side income has increased to $1,500 each month. Compared to when she started the recession, Rachel had more money, more sources of income, and more self-assurance. Two individuals, the same starting place, entirely different preparation, and very different results. The majority of people are unaware of this fact concerning wealthy people during recessions. In reality, it has nothing to do with the money. Indeed, having money, possessions, and several sources of income are helpful, but the true distinction is psychological. Rich people have conditioned themselves to view turbulence as an opportunity rather than a danger. Their minds are wired to rush toward terror rather than away from it. But here's the thing, you don't naturally possess this personality feature. It's a skill that you can learn. Recall your very first experience driving on a freeway. Scary, isn't it? There are fast-moving automobiles everywhere. A single error could have disastrous consequences. However, it became natural after you did it 100 times. It ceased to appear as a threat to your brain. It became into just another action you take. Investing during a downturn is identical. It's terrifying the first time. Your entire body is screaming for you to stop, sell, or defend yourself. However, something changes if you can overcome that anxiety and force yourself to continue investing or even make further purchases. There's less fear in the second recession. You practically look forward to the third one. You've noticed the pattern, not because you're heartless or don't care about people suffering. It's only transitory, you know? You are aware that opportunity lurks within the confusion. Rich people aren't particularly brave. Simply said, they repeat more. They've experienced enough cycles to understand that this will also pass. That while 20 years ago was the ideal moment to plant a tree, the present is currently the second best time, particularly in light of the widespread belief that trees will never grow again. Let's bring everything together. The discount for emergencies. When fear takes precedence over reason, assets are put up for sale. The benefit of liquidity is having money on hand when everyone else is compelled to liquidate. Income insurance, as well as several sources of opportunity and stability. The information gap, the ability to distinguish between panic pricing and true worth, the patience paradox, and the luxury of waiting while others are in need of money. Now, you don't have these character defects. One step at a time, anyone may incorporate these regular patterns into their financial life. Whether you will have another recession is not the question. In your lifetime, you will most likely have multiple. That being said, what will you do differently? When everyone else is panicking, will you too panic and sell? Or will you be the patient, knowledgeable, and wealthy person who navigates the chaos and finds deals? Get started right away. Create an emergency fund. Study up on investment. Establish a second source of income. When markets decline, practice remaining composed. Because this is the reality. No one wants to publicly declare, the next recession is on the horizon. It might happen next year or in 5 years, but it will happen eventually. Additionally, it will move wealth from those who are ill-prepared to those who are. Which side would you prefer to be on that transfer?